Hey guys, Brian's here. Today is Sunday, November 10th, 2023, and I'm pretty sure the question on everybody's mind is, will the markets finally make a big move this week, either up or down? As price action has been consolidating and contracting, the daily net changes have been decreasing since the middle of November. The VIX is at a low that it hasn't been in a while, and it has been remaining low over the past couple weeks. So the question on everybody's mind is likely, will the markets have a big pullback? Or will we explode or start a new trend to the all-time highs? Or not necessarily a new trend, because I guess this trend started here back at the start of November towards the end of October. And the reason for thinking this is more than likely going to be, if we take a look at the economic calendar, we can see that we have the CPI reports on pre-markets on Tuesday. We have the PPI reports also on Wednesday. Then we have an FOMC conference Wednesday afternoon. These are all Eastern times, by the way. Then we also have some retail sales, unemployment numbers on Thursday. And then we have the manufacturing PMI on Friday. So it seems every single day this week, except for Monday, there are some major potential catalysts that can help trigger or cause the markets to make a large move. On top of that, if we take a look at the net changes over the past few days in the markets, what we're looking at right here, this is the SPX, and I just have it sorted by the most recent dates. So as you guys can see here, this was Friday, then we have Thursday, Wednesday, Tuesday, Monday, previous Friday, and so forth. And at the top of this list here, if we just take a look at the net changes, so Friday had a net change of 0.41%, Thursday had a net change of 0.73, and so forth. The reason of why I'm pointing this out is if we take a look at how many days did we actually have a percentage of greater than 1%, we have to go all the way back to right here, and this was actually November 24th, and that was the day in which the market gapped up, as we can see right here on the chart. So we had this major gap up. If you don't know what a net change is, it is just the change from the previous day's close to the current day's close. So in other words, on this day here, the market's closed right at this level, and then the next day it closed all the way up here. So that will be the net change from here to here. When we take a look at that, if we jump to the intraday chart right here, we can see that for the past few days, again, for the past couple of weeks, the market opens here. The previous day it closed here, so that's not that large of a move, although that is a gap up. And this day here, the market's closed here, but then it ended up closing here the next day. The next day it ended up closing here, then it closed here. If you were to draw out some sort of a line and you connect these, you can see that the market is in a sense really going nowhere. Even this day where we closed here, by the next day it ended up closing right here. So the net change is not that crazy. It's very small. Even though we gapped up, market ended up selling right back off to here. Now for option sellers, this is great because it means if you're running some sort of iron condors for the week or some sort of iron butterfly, these trades have been paying pretty well. But I don't really want to talk about spreads in this video. I just want to just point certain things out, bring it to your attention in case you are unaware of. Whenever the market has contracted like this, the expectation will be we'll have some sort of a day in which the market will probably do over 1.5%. The question is, what day will it do that 1.5% move? In which direction will it go? No one will know for certainty, but we can make some sort of an educated guess that it's likely going to happen within this week, and if not this week, then definitely the following. Because in an often scenario that we'll see, although I don't think this is probably what's going to happen this week, the reason I don't think that's going to happen this week is because the VIX is so low. So if we come here and actually take a look at the daily on the VIX, and let's take a look at a few more years for reference. Let's go back maybe 10 years. And I don't generally extend my lines to the left, but let's extend it all the way back to the left. So we can see this is where the VIX is. This is pre-COVID era. So this is 2019. This is the start of 2020. So again, pre-COVID, we are at levels that we have not seen since before the crash of 2020. We were at this level earlier in the year, but as you guys can see, we ended up just touching level, bouncing off a little bit again, then touching it, then touching it. This has been a couple weeks in which the VIX has just been consolidating right at this level. And that's a little bit of a different characteristic, which we haven't seen. But if we were to jump back to periods back here in 2019, you guys can see that we have a little bit of a consolidation here, and then we end up getting a little bit of a pop. Whether it lasts for an extended period of time, such as this, no one will really ever know that for certainty. But you guys can see in this case, the VIX has trended or consolidated around this level for about a couple weeks to 3 weeks or so. We're now entering 2 weeks in which the VIX has been stuck at this pre-pandemic or pre-2020 level. So that's what's something that's pretty interesting. It's going to cause a lot of traders to expect some sort of volatility to enter back into the market. What's also interesting is this is a week in which we have all of these catalysts, and yet the VIX closed at the lows on Friday. It's not that common for the VIX to decline on a Friday and a Monday, so that's not really uncharacteristic for it. However, what is uncharacteristic is the fact that it did that leading into what would be presumed to be a potential volatile week. It closed at the lows. So it won't be surprising if tomorrow the VIX actually gapped up and kind of reset itself for the week, because all of that expected or implied volatility needs to be baked into some of the options pricing for this week. If we were to head back to the SPY, I want to take a look at some price action and point some things out to you guys. So let's actually start with the SPY. We have this gap up here on Thursday was something that should have surprised a ton of bears. And on this day, we had price action to tell us there were some certain clues here. So if we actually just take a look at the point of controls for the week, this was the day right here in which I'm talking about. Thursday, the SPY ends up gapping up. So we have all this potential demand that had built up here, everyone expecting that to be supply because the market's closed below it. But once we gapped up over that level on Thursday, this was also the 2-day anchored VWAP. If you've seen any of my previous videos, then you know I love whenever the market has trended in one direction and then the following day it gaps up in a different direction. If it gaps up above that 2-day anchored VWAP and we have some sort of confluence from the volume profile, the expectation will be that the market would trend higher. Now, I know for some people viewing this on YouTube after the fact will often say it's easy to call this out, or putting out after the fact, or, it's easy to look at price action hindsight. But I just want to bring it to you guys' attention here. This is actually on Thursday as the market opened, just already pointing out that, or bringing awareness to the attention here. This is that 2-day anchor view up on the SPY. This is that week to date point of control. If you follow any of my gamma exposure playlists or anything in that series that I try to do every week or so, I've tried to share some of these levels. I've been now getting into the habit of sharing them on YouTube so you guys can kind of plan for your week. I'm planning to record that video a little bit later tonight. As the closer you do that analysis to the market open on Monday, the more accurate gamma exposure levels you'll get. So I'm going to hold off from including that in this video. So disregard these other levels that you see on the chart right here and just pay attention to that 2-day anchored VWAP. The 2-day anchored VWAP has been one of my favorite tools over the past 4 years, and this is one of the simplest strategies that I like to implement whenever I'm looking for some sort of a directional bias. Market is trended in one direction, it gaps up the next day. As long as it is holding that 2-day anchored VWAP past the morning session, so after an hour and a half or so after the market is open, if we're still holding that level, then the expectation will be that we will trend up, because all of the bears that were been shorting the previous day are going to start closing out their trades because they were wrong. They expected the price to continue going lower, but it did not. On top of that, we have the supports of the volume profile backing up this trade idea. And there's been an extensive video on this YouTube channel explaining that. So that's this price action right here. On top of that, if we were to take a look at the SPX, this is something that price action has been hinting at us. This is something that price action has been hinting at us for a while now. And if we're disregarding or throwing this out, you're missing out on some clean clues. This is a clean uptrending channel on the SPX since this gap up here. So from the middle of November, this is November 14th, the SPX has been a pretty clean uptrending channel. If we take a look at this on the daily, and we we zoom in right here, we can see that this is a pretty important level. So this is just the most recent major rejection. That's actually where the SPY ended up, or the SPX ended up meeting some sort of resistance here. So I'm just going to plot this out on the chart. Let's just go back to the intraday time frame. You guys can see this right here. This is not a surprise that this is where we rejected at on Friday. I'm going to delete that. The thing to take note of is this is the Thursday we gapped back into this channel. So price gapping back up to the channel is another indication or another sign that whoever was short here, because this is the break of the channel, they were wrong. We gap back into the channel. The expectation will be that price will trend towards at least the midpoint. And if it holds above the midpoint, the expectation would be that price would head towards the upper end of this channel. That's just the way price action has been trading. Now, if we're expecting some sort of increased volatility and you're waiting for signs to take a trade in a certain direction, one of the things to look for will be a break of this channel. So if we were to just extend this out to the right, I'm just going to draw it out that way. So there we go. Now we have it. It's extended infinitely for this upcoming week. So now I'm going to sit back and wait to see which direction will the SPX actually break. If one of these catalysts, just to say the CPI report that comes out, ends up causing the market to gap up above this level, I'm not going to look to take a short trade unless price gets back into this channel, tries to go higher and fails. Then the expectation will be the SPX is going to sell all the way back off down to this channel. This will be a good place to take profit with the expectation that this level will not hold again, because now we have some sort of catalyst. So from a price action standpoint, an expectation can be market, let's just say, gaps up here. It doesn't hold that gap, it gets back within the channel, then it tries to go higher, it ends up rejecting that level, and then it sells all the way off back to the support level of the channel. Then price tries to bounce, cannot hold that bounce, and then it goes lower and breaks this channel. Now we have a clear sign. Price action is letting us know that bulls are no longer as aggressive, and we can expect price to end up selling off past what the expectation would be for this upcoming week. On the other end, let's just say price was to gap down below this channel, and then it got back within the channel sometime this week, and it held that level. The expectation will be something similar that we experienced here on Friday and Thursday. So just trade what you see on the chart. Just keep it simple. There's no need for me right now to have any other additional support and resistance lines. Obviously, I'll use some of customizable studies. I'll take a look at the volume profile. I'll use some of the quant trading app tools. But at the end of the day, it's just simple and basic price action for me. And knowing that there are these catalysts on the horizon is why I'll have certain expectations. The expectation is also not a directional bias. The expectation is an expansion of volatility. In other words, I'm expecting the markets to make at least a 1.5% move on any given day this week. Part of the experience that comes with trading is knowing when to be aggressive and when not to be aggressive. A lot of beginner traders, I'm pretty sure, have been burning themselves out over the past couple of weeks trying to scout for these pennies on these days where the opportunity is not really there. And what happens is we become trained and conditioned to scalp in these micro movement type of environments. And then when the market has a big trending day, what will happen is a trader will often enter a trade. Let's just say you trade here, you get short, and then you scalp, and then you take profit right here. And then the market ends up doing something like this, where it drops all the way down here. And then you end up saying, oh man, if I held, if only I did this, or I made a mistake, or I should have not take profit. That's why I don't like taking profit early. But no, in a sense, you only did what you were trained to do over the past couple of weeks. If this is the move that you capture on a potential short move this week, that's a good move, because if you take a look at the previous days, those were moves that you were getting. So your mind or your brain at this point is conditioned to just look for these little small micro moves. How are you going to expect to catch a move this large if all you've been doing for about 2.5 weeks is just scalping for these micro moves, versus preparing your mind at the start of the week that we can have a major trend that can form during this week or at the start of the following week because of this compression. From compression comes expansion. The compression is showing up in the price action. It's also showing up in some of the data. It can't be, argued. It can't be denied against. We've seen it in the VIX. The VIX has been dropping. So all of these things are pointing to compression that's happening in price action. And again, from compression comes expansion, and from compression usually comes the start of another trend. Whether the market will reverse or whether the next trend up will be a little bit more of a parabolic trend to all-time highs, again, we don't know. Those are the expectations. On the other end, there are option sellers that know everyone is expecting a large move, so they're going to try to sell options to people thinking there's going to be a large move. The problem is right now is they don't have the same edge because implied volatility is so low. That means they're selling calls and puts, and they're not collecting as much premium as they once were, so they're actually taking on more risk. I know this as an option seller myself. These are environments in which we set ourselves up to potentially take major losses. So instead of selling options on a time like this, I'm waiting for another nice directional move where I would actually like to be an option buyer. Lastly, I'd just like to point out a little tip if you guys don't know this or you're not aware of this. So if you were to come to something like the SPX, and what I did is I marked up a straddle. So straddle is just when you buy an at-the-money call and an at-the-money put. I'm not showing you guys, this is a position that I currently have running, but that's not what we're showing in this video here. It's just a demonstration on this risk profile. I have it limited to just show this one position right here. So if I were to turn this off, you guys can see that this is a clean risk profile. It's not including any of the positions that I currently have open. But as we take a look at this right here, this is an at the money, this is a straddle, so it's just the purchase of an at the money call and a put on the SPX. You can actually use this as an idea for a gauge for the expectation for the range for this week. So in this case here, we're looking at the December 5th expiration, which is this upcoming Friday, the PM expiration, not the AM. And we're taking a look at, this is what it's saying right now would be the break evens on this straddle. In other words, if we take a look at this right here, this is letting us know 46.63 and 45.46 is the expected range. We can also take a look at this right here, and this is 64 points. This is going to give us a little bit of a different number, but you can use this as a gauge for that range. You can also take a look at this as the expected range for the markets. If you're not using Thinkorswim, you can use this method. You can use a tool such as Option Strat, and then all you have to do is just plot these levels on your chart. So if we were to draw this right here, so 64, I'm just going to round it up. I did a previous video that showcased how you can actually have this automatically happen, but I'm going to just do it manually here for this video. And then we have 46. So down here would be 46. All right, so let's zoom this in. And we have the implied expected range, if you will. So 46.64, sorry, 46.64. I'm gonna just make this solid. And then we have 45.46, 45.46. Also, just make this solid. 45.46. Again, I'm not going to make it perfect to the penny. What we have here, this is our range expected for the week from the options market for the SPX. In other words, look at where this coincides with. Don't know if this coincides with the level on the daily chart, but this is another way that you don't have to spend so much time drawing out potential ranges or expectations and so forth for the week. The options chain is letting us know these levels don't work all the time because nothing works 100%. But now we have some sort of an idea that, let's just say the market was to gap up to over here, and then it held this level, and then it pushed up here. Expect some sort of, resistance or profit taken around here, or consolidation. If the market consolidates around here and then it continues to hold here, the expectation would be that it's going to go higher for this week, or definitely it will be breaking out of the expectation for the week. Volatility will probably expand, especially if we come down to this downside. So if the SPX was below this level for this week, we can expect some sort of a larger move. That's just a little bit of a tip. I'm not sure if any of you guys know that on YouTube, but I figured I'd just share that to include in this video for how you can prepare for this week. What would constitute as a large move for this week? In my opinion, anything past these levels right here would be considered a big week for the market, considering how it's been trading. Hopefully you guys enjoyed this video. I'll be recording another one. I'm planning to record another one later today on the gamma exposure to help assist and prepare for this week ahead. Thanks for watching, guys, and I'll catch you in the next one.